Welcome back to Global Derivatives TV. I'm Brenna Hardman here with Christopher Cole from Artemis Capital Management. Christopher, nice to have you here with us.
Good to be here.
If you could just start and tell us about your background and how you came to start Artemis Capital, that would be great.
Artemis Capital was founded in 2009. It's a firm that focuses primarily on trading volatility derivatives with an emphasis on exchange-listed vol derivatives like VIX futures and options.
And I just saw the YouTube video you came out with, Volatility at World's End, which is quite fascinating. You can find it on YouTube at Artemis CM. And can you tell us what inspired you to do this and how you made it?
Well, you know, for a long time, part of my work has always been trying to visualize the way the volatility surface behaves. And that's been a big part of how I look to trade and make money in these markets. Living near the ocean, I always looked at it as a metaphor for water and for waves. And I thought there's got to be a way to visualize this to show clients what this abstract volatility curve looks like in motion. So very early on, started trying to animate that in very crude ways using traditional finance programs and algorithms. And then for this conference decided, well, wouldn't it be interesting to present a video of that? So we actually got together with programmers, with my team working to do calculations on the variance swap surface, and then also with artists in the Los Angeles and global area, and came up with this 4-minute video that shows the transformation of the volatility surface over the last 20 years. It's all real data. It's entirely real, but maybe presented in a way that people haven't seen that type of information presented before.
And how long did it take you to make this video from concept to completion?
I think the whole process was about 3 months in total. We started out by compiling history of the implied volatility surface and the term structure, looked at running that data and having that transition into realized volatility data, and then there was a back and forth process with the creative team to understand ways to animate that in a way that made it look interesting to the viewer.
And then I noticed the song that you played in the background was called Blood. Can you tell us why you chose that song in particular?
We wanted to find a part of the concept of this was to make it not only informative for the practitioner, but also entertaining to someone who maybe doesn't trade volatility on a day-by-day basis. So we wanted to make it accessible and exciting. So Blood is a song that is a little bit retro in nature. It's got some techno elements, but also has this kind of old feel to it. So we thought it would work very well with this very technical data set and maybe add a lot of energy. It's done by a French DJ named Mansour Adi. He's a really up-and-coming DJ in the Paris area. So it's just an interesting juxtaposition of two worlds that you probably normally wouldn't see.
And I definitely recommend people watch that. To be quite honest, I was fascinated that someone would think of this and make it, and it's very interesting for someone that's not familiar with that to see. So I want to move on to a more technical side. Now, can you enlighten me on changes in volatility pre-financial crisis to now, and what transformations you're seeing taking place?
I think it's important to kind of define what we mean by volatility. I think you're seeing a lot of changes post-crisis, but one idea is to look at the S&P 500 variance swap curve, and then there's a different way of looking at volatility, which would be realized, and then also the VIX futures curve is the proxy for forward variance minus convexity. I think you're seeing a tremendous amount of fear that's being built into these curves now. The term structure of the volatility curve is much steeper than it ever has been historically in 20 years. And my interpretation of that, there's one interpretation which is quantitative, which says you have a higher risk of jumps that are being built into that curve. But another interpretation is really a macro behavioral interpretation, which is this idea that zero interest rate policy, financial repression by central banks, is forcing a lot of people to get into risk markets, and they don't feel comfortable doing that. So they're looking at ways of hedging. And as a result of that, they're buying volatility on the long end of the term structure and bidding up tail risk insurance, which has caused these massive shifts in the volatility markets, the markets that I trade every day.
And what kind of strategies are you doing right now or recommending in VIX and VIX options?
Well, I think most recently one of the most interesting structural dynamics has been the influx of these VIX ETNs. They've been tremendously popular with retail investors. This has caused tremendous dislocations on the front of the VIX term structure and in VIX options. At least in the first quarter. Now this process has normalized quite a bit. The curve is much more linear than it has been in the past. But during the first quarter, we saw a tremendous amount of opportunities in vol being overpriced comparative to where it had been in the past at different points in the term structure, hedging out that vol inefficiency using calendar spreads, or also looking at ways to play off that term structure in an efficient way to extract out that premium that was really being created by excessive movements and vega flows that came in largely through VXX and TVIX inflows.
Well, the ETN, makes me think of regulations, and there's a lot of discussions on what to do about that. Can I ask what, if any, regulatory issues are affecting your business and how you might be preparing for that in the future? I think there's a lot of tremendous amount of regulatory changes that have come through. Without getting into specific comments on it, though, I think the key thing that at least my frustration, or whenever I talk to regulators, I think as an investment manager, you want regulation because it enhances transparency and it enhances trust in our industry. You just want smart regulation. Right. So when I see intelligent questions and when I see intelligent regulation that helps on those two levels, I find that very helpful to the industry. I sometimes get frustrated when there doesn't seem to be an overall game plan, or it's not enhancing those two aspects. And so it's just the nature of the business now, but it's a new reality that we have to live with. On a structural level, I think one interpretation for higher volatility on the back of the term structure may be regulatory. If you're looking at Dodd-Frank and the Volcker Rule, you're seeing it's much more difficult for banks to have to sell volatility via structured notes. And as a result of that, they've pulled back that supply in the market. So one interpretation beyond the macro and quantitative element in terms of the shape of the vol structure may be just a regulatory interpretation to say that they have to pull back those vega flows, and as a result, the term structure has steepened because there's less supply of volatility there. All right, and one last question. Where do you see volatility as an asset class in 10 years?
I think it's a very exciting time for vol. You have a product that used to be really just the domain of investment banks and high-end traders, and now you're seeing it being democratized to a certain degree with retail investors. I think the growth of volatility and listed volatility derivatives is going to be very exciting over the next 10 years. I think looking back, people will really see this as kind of a golden era of the emergence of this asset class. And I think that times will be very good in terms of people looking at new and creative ways to use these products in an educated fashion to enhance their portfolio and also to and their risk-adjusted returns.
Oh, very good. Well, thank you for watching here at Global Derivatives TV, and stay tuned for more interviews at the Risk Management Conference.